Hey everyone, and welcome back. In Module 1, we set up the basic skeleton of our financial model. Now, in Module 2, we're going to give that skeleton some muscle. This module is all about setting up our data correctly from the start. Trust me, spending a little time organizing things now will save you a massive headache later. We'll learn how to properly classify our costs, build clean and separate input tables, and use some fantastic Excel tools to make our model robust and error-proof. Ready to build a rock-solid foundation? Let's get into it. Categorizing business costs, fixed versus variable. Okay, first things first. In any business, money goes out for different reasons, including operations, production, marketing, etc. To make sense of it all, we need to split our costs into two main categories: fixed costs and variable costs. Understanding the difference between the two is one of the most fundamental concepts in business finance. Let's take an example business. If you own a business and pay for shop rent every month or year, the rent you paid to keep the shop is a fixed cost. It does not matter whether you use the shop for business or not. Even if you lock the shop for 1 year, at the end of the year, you'll still pay your rent. However, if you start using the shop for business, you might incur additional costs, including utility bills, shop maintenance, etc. These costs vary based on the volume of usage. If you did not use the shop at all, you may not have a bill to pay. However, if transaction volume increases, your bills are likely to increase as well. Using the above examples as a template, let's now formally define fixed and variable costs. Fixed costs are expenses that stay the same regardless of how much you sell. They are the baseline costs of keeping the business running. For Greenleaf Bakery, the rent for the bakery is a perfect example. Whether they bake 1 loaf of bread or 1,000, the landlord will demand his 450,000 Nigerian nairas every month. The same goes for staff salaries. Variable costs are expenses that change in direct proportion to how many products you make or sell. In the case of Greenleaf Bakery, the flour needed for a sourdough loaf is a classic variable cost. If you bake more loaves, then you will need more flour and the cost goes up. Similarly, if you bake fewer loaves, the cost goes down. This is also true for the direct labor cost, that is, the time a baker spends on each loaf. Now, with the definitions in place, let's look at our simplified data and categorize it. This table shows the cost classification of our Greenleaf Bakery base data. Why is cost classification so important? Because it helps us to answer the most critical question in business. How much do we need to sell just to cover our costs? This is called the break-even point, and we can't figure it out without first separating our fixed and variable costs. We'll dive deep into that in a future module. Before we wrap up this lesson, note that a fixed cost for business A may be a variable cost for business B. For example, we classified utilities as a fixed cost above. However, if your business is using electricity in production, the monthly bills will vary based on the volume of use. Thus, you should be the one to determine which costs are fixed and which ones are variable. As classified in the above table, variable costs are costs that directly affect production, while fixed costs are predetermined. But here is a quick exercise for you. Imagine that Greenleaf Bakery pays a 20 Nigerian nairas transaction fee to its payment processor for every single loaf of bread sold online or with POS. Is that transaction fee a fixed cost or a variable cost? Pause the video and think about it. Then, write your answer in the comment. If you said variable cost, you are right, because the total fee depends directly on the number of loaves sold. Now that you can categorize the different business costs, we'll focus on setting up our input table. In our next lesson, you'll learn exactly how to do this using our baseline data provided earlier.